I'm Laura Davis, an ACTEC Fellow from Dallas, Texas, and I'm here with Farhad Agdami, an ACTEC Fellow from Richmond, Virginia. Today, we're going to talk about the basics of fiduciary income taxation. Farhad, what does fiduciary income taxation mean?
Yeah, well, good morning, Laura. It's good to see you again. It's good to be here. Fiduciary income taxation is really the income taxation of estates and trusts. And that should be contrasted with the estate tax. I know we use those terms somewhat interchangeably, but when we're talking about fiduciary income taxation, we're really talking about the income taxation of the assets that are in a person's estate, or the income taxation of assets that are held in a trust. And this should be contrasted with the estate tax, which is really sort of a one-time tax that occurs at a person's death. And I'll use a simple example or simple analogy to explain the distinction. Think about a farmer who owns an apple orchard, and the farmer passes away. There may be an estate tax due on the value of that apple orchard, and you'd have an appraiser determine what the value is, and you would subtract any applicable deductions and a credit. There's an $11.7 million estate tax credit that's available, and that's sort of a one-time tax that's paid. The fiduciary income taxation, though, is really the tax on what is generated by that property. And if you've got an apple orchard, you're growing apples every year, and the income is really the apples that are being grown every year. That's what's being generated from that property. And so you file an annual income tax return reporting the income that's generated by property.
So let's parse it out a little bit. Can you explain exactly what an estate is?
Sure. So when a person passes away, the assets that they own are all now held, that they owned at the time of their death, are held in their estate. And the estate really captures all of the income. Fiduciary income tax return captures all of the income that's earned during the period of estate administration, really from the moment of death until the assets are distributed to the beneficiaries. So if a person dies, let's say on May 17th, all of the income that they earn from January 1st to May 17th while they're alive would be reported on Form 1040, their personal income tax return. And then all the income starting from May 17th through the end of the year would be captured on a Form 1041, which is the fiduciary income tax.
Oh, okay. That makes sense. And so what's a trust?
Yeah, a trust is really an arrangement where property is transferred to a person who's known as the trustee, and they hold and manage that property subject to the terms of a trust agreement, typically in writing, for the benefit of a beneficiary, and the trustee owes certain fiduciary duties to the beneficiary. Trusts can be revocable, that is, they can be amended, changed, revoked, or they can be irrevocable. Often revocable trusts are used really as will substitutes, and they're often referred to as living trusts, whereas irrevocable trusts are created during lifetime, often for gift planning purposes, where you want to make a transfer to an irrevocable trust and make sure that a gift is complete for gift tax purposes. Also, revocable trusts become irrevocable at a person's death because they can no longer amend it or change it.
Gotcha. So there's lots of different kinds of trusts. From an income tax perspective, how are trusts generally taxed?
Yeah, generally, they really work with what I call sort of a modified conduit form of taxation. And the way I sort of think about it is if a dollar of income flows into the trust and the trustee holds on to that income, then the trust pays tax on that income. If the trustee turns on the faucet and says, hey, we're going to allow this dollar of income to flow down to the beneficiary, then the beneficiary has received the income and they pay the tax on that, and the trust gets an offsetting income distribution deduction.
So from a tax perspective, trusts fall into three broad categories: simple trusts, complex trusts, and grantor trusts. Will you explain what those are?
So a simple trust is a trust where all of the income must be distributed out to the beneficiary annually. And so basically, if there's any income, interest, dividends, rents, proceeds from the sale of apples. If that comes into the trust, the trustee is obligated to distribute the income out to the beneficiary. A complex trust is a trust where the trustee has discretion to either distribute some, all, or none of the income out to the beneficiary. And then there's a third type of trust, which is called a grantor trust. And that's a trust where actually the person who set up the trust and not the beneficiary is taxed on the income. And there's certain reasons why, there's certain powers that cause a trust to be considered a grantor trust. And actually, there's a subset of grantor trusts where not the grantor, but the beneficiary is considered the owner of the trust income.
So, a lot of people ask if trusts are taxed at a higher rate, and we know the answer to that is no, but that is somewhat misleading. Will you explain how trusts are taxed differently than individuals?
Sure. So you're absolutely right that trusts don't pay tax at a higher rate, but they get to the higher rate much more quickly. So in the case of a married couple that's filing jointly, they don't get to the top income tax rate of 37%, the top bracket, until they have about $628,000 of income in 2021. So there's a lot of income that doesn't get taxed at that top rate. You have to get to 628. Whereas in the case of a trust, they get to the top tax rate of 37% with only about $13,000 of taxable income. And so the trust tax rates are very compressed. And so keeping income inside a trust can be disadvantageous because many of the dollars are ultimately taxed at the highest rate. There is the ability to distribute income out to a beneficiary, and it's important for trustees to sort of monitor trust income because you could potentially distribute income out to the beneficiary at a lower tax rate.
That's great information to have, Farhad. The tax return used for trusts and estates is a Form 1041. Who files that income tax return and when is it due?
Yeah, so typically the fiduciary, whether it's the executor or personal representative of the estate or the trustee of the trust, they're responsible for preparing and filing the fiduciary income tax return, the Form 1041. That's typically due on the 15th day of the fourth month following the close of the trust or estate's taxable year. And in most calendar year trusts, that will be April 15th of the year following the year in which the trust had its prior year. And then estates can be on a fiscal year, and as long as the first fiscal year is no longer than 12 months. And so it would be due on the 15th day of the fourth month following that, the end of that year.
Great. So, how do beneficiaries report the income that they receive from the estate or the trust?
The beneficiary reports the income they will receive from the trustee or from the estate a Form K1, which reports their share of the income, gain, loss, credit deduction from the trust that is passed out to them. And so they'll take that Schedule K1 and they'll enter the information from that K1 on their personal return, and that's how they effectively report that income.
So, does a trustee of a grantor trust always need to file a Form 1041?
Not in all cases. There are really two methods. First, you can prepare and file a grantor trust tax return, which is really an abbreviated return. It just has the name of the trust, the trustee, and their address, and then it is attached to it sort of a list of items of income, gain, loss, credit, deduction, and those are almost act like a K1 for the grantor, and they would report those on their personal return. And then in some cases, a grantor trust return is not filed at all, and all of the items are reported just directly on the grantor's personal return.
Great. That seems a little bit easier than filing a return. So, can you explain again how fiduciary income taxation is different from estate taxation?
Sure. Estate taxation really it looks at the value of a person's estate at the moment of death. You sort of take a snapshot of the value of all the assets in their estate at the time of death, and you value those, and you subtract any deductions or any credits or exemptions. And as I mentioned, there's an $11.7 million estate tax exemption that is available. And that's a one-time tax that's paid. It's typically due 9 months from the date of death. In the case of fiduciary income taxation, that is really on the income that's being generated by those assets in the estate. And so, as use the analogy with the apple orchard owner, if the farmer dies, the estate tax is on the value of all of his trees and his farming operations, and you'd value all those, and you'd pay this one-time estate tax. But also, those trees are growing fruit each year. And when that fruit is sold, that is generating income. And that's where the fiduciary income tax would come into play. And you'd report the income from the apple proceeds that are sold.
Great. That's helpful because I know it's always confusing that there's two estate tax returns. Farhad, thank you so much for your clear explanations of fiduciary income taxation and the Form 1041.
Thank you, Laura. It's great to see you again. I appreciate it.